Welcome back to Explain the Charts. Today, August 11th, 2025, we're diving deep into NZDUSD, covering both recent news and critical chart patterns. Recent market sentiment is heavily influenced by central bank policies, with the Federal Reserve's dovish outlook and traders anticipating potential September rate cuts being a key driver for the broader dollar weakness. We've also seen the Bank of Canada and Bank of Japan's upcoming policy decisions adding to overall currency volatility. The US dollar experienced a strongly volatile weekly open on Monday, dropping midweek, which contributed to the euro hitting a one-week high. Crucially for our pair, the New Zealand dollar significantly strengthened against the US dollar on Wednesday, reflecting this broader USD weakness. While the US dollar aims for its first monthly gain in 2025, this appears to be against other currencies, as NZDUSD saw local strength. From New Zealand's side, the unemployment rate edged up to 5.2%, a figure that beat market expectations but revealed softer underlying details, suggesting growing economic slack. Lastly, President Trump's hint at potential new Federal Reserve Chair candidates like Kevin Warsh and Kevin Hassett could signal shifts in future monetary policy, a long-term factor to watch. Now, let's turn our attention to the daily chart of NZDUSD, showing all available data. Looking at the broader picture, we can clearly identify a significant downtrend from late 2024, marked by several sharp declines. Notice the extreme lows reached in November and December 2024 and January 2025, with wicks touching levels as low as 0.42161. These deep wicks, while representing temporary flash crashes, indicate strong buying interest and price rejection at those levels. However, more importantly for long-term support, the closing prices in these periods established a crucial floor around the 0.49 to 0.51 zone. Since those lows, NZDUSD has entered a clear medium-term recovery phase, steadily climbing back towards the 0.59 to 0.60 range. This recovery aligns with the recent news of the US dollar's broader weakness and expectations of Fed rate cuts, making the New Zealand dollar more attractive. A key resistance level on this daily chart appears to be the previous highs around 0.63 to 0.64, particularly from September 2024. The price has not tested this level since the downtrend began, so it remains a significant hurdle if the bullish momentum continues. Current trading is consolidating around the 0.59 to 0.60 level, acting as a crucial pivot point. Zooming in on the 1-hour chart provides a more granular view of the recent price action, specifically from late July 2025. Here, we observe a period of relatively stable, slightly bullish consolidation within the 0.59 to 0.60 range. The price has been making higher lows and higher highs within this channel, indicating sustained, albeit slow, upward momentum. This hourly chart confirms the daily sentiment of a gradual recovery, despite the overall long-term downtrend. Notice the moderate volume during this period, suggesting a controlled accumulation rather than aggressive breakout trading. Key support on this hourly time frame can be identified around 0.594, which has seen repeated bounces. Resistance on this chart is around 0.605, marking the upper bound of this recent trading channel. A break above this 0.605 resistance would signal stronger bullish intent for the short term. Let's narrow our focus even further to the 15-minute chart, examining the rapid price action and volatility experienced during the midday trading on August 6, 2025. Specifically, if we filter the candles from approximately 12:46 Universal Time Coordinated to 15:46 Universal Time Coordinated, you can clearly see the notable upward surge mentioned in the news. During this time frame, NZDUSD rallied from around 0.5923 to 0.5935, coinciding with the reported New Zealand dollar strength. This short-term rally, however, was met with some selling pressure, leading to subsequent consolidation, highlighting the two-sided nature of the market even during strong moves. The rapid shifts visible here demonstrate the market's immediate reaction to news and how quickly intraday trends can form and reverse. For short-term traders, The 0.5923 level acted as initial support for this rally, while 0.5935 served as a temporary resistance. The short-term bullish sentiment is strongly supported by expectations of a dovish Federal Reserve, potentially leading to rate cuts, which weakens the US dollar. The New Zealand dollar has shown impressive resilience, rebounding significantly from its multi-year lows, suggesting strong underlying demand at those depressed levels. Furthermore, the strong buying pressure seen on the daily chart during flash crashes, indicated by the long lower wicks, suggests that deep pullbacks are actively bought up by institutions. A sustained break above the 0.605 level on the 1-hour chart would open the path towards challenging the more significant resistance around 0.61 to 0.62. Long-term bulls will be looking for a decisive breach of the 0.635 major resistance, which would signal a complete reversal of the previous downtrend. The market's current focus on Fed policy could overshadow local New Zealand economic data, providing continued tailwinds for the NZD. Conversely, a bearish outlook remains plausible, particularly in the long term, as the overall downtrend from late 2024 remains intact until the 0.635 level is convincingly broken. The softer details within New Zealand's unemployment data, despite beating expectations, hint at growing economic slack, which could eventually put pressure on the RBNZ to consider more dovish policies, weakening the NZD. Any unexpected hawkish shift from the Federal Reserve or robust U.S. economic data could quickly strengthen the dollar, pushing NZDUSD lower. In the short term, a breakdown below the 0.590 support, visible on both the daily and 15-minute charts, would suggest a resumption of the recent minor bearish correction. Should this level fail, we could see a retest of the 0.585 support and potentially the significant psychological level of 0.580. Traders should be wary of the extreme volatility and flash crashes observed in late 2024 and early 2025, as similar liquidity events could occur unexpectedly. When considering trading NZDUSD, several factors are paramount. First, always monitor upcoming economic releases from both New Zealand and the United States, especially inflation, employment, and central bank announcements. The upcoming Fed decision and any further hints on their rate path will be critical short-term catalysts. For long positions, look for clear breaks above resistance levels like 0.605, ideally confirmed by increased volume, targeting the next resistance at 0.61 to 0.62. Set stop losses below immediate support, such as 0.590, to manage risk effectively. For short positions, a break below 0.590 with conviction could present opportunities, targeting 0.585 and then 0.580. Ensure your stop loss is placed above the broken resistance, for example, above 0.595. The price action around these key levels will tell you if buyers or sellers are in control. Pay close attention to candle formations, such as large bullish engulfing candles for entry signals or bearish reversal patterns for exit points. The volume accompanying these price movements can often provide confirmation. Higher volume on breakouts or breakdowns adds conviction. To recap, NZDUSD is currently hovering around the 0.594 level, showing signs of recovery from significant early 2025 lows, fueled by expectations of a weaker US dollar. Key price levels to watch are the immediate support at 0.590 and resistance at 0.605 in the short term. In the medium to long term, major resistance stands at 0.635, while strong historical support sits in the 0.50 to 0.51 range. The likelihood of an upward move towards 0.605 appears moderate to high, 65%, contingent on sustained USD weakness and positive market sentiment surrounding rate cuts. A downward move towards 0.590 or even 0.585 is also possible, 35%, if US data surprises to the upside or Fed rhetoric turns unexpectedly hawkish. Traders should closely watch for any significant changes in central bank tone, particularly from the Fed, and always prioritize robust risk management. The volatile nature of this pair, evident in past flash crashes, demands careful attention to liquidity and sudden price swings.